Welcome and good morning. We're so pleased that you've joined us for our webinar, Measuring Stakeholder Capitalism. We are an amazing audience of 5,000 strong, which is a true testament to how important and critical this topic is. I'm our moderator, Betsy Atkins. I'm a CEO, serial entrepreneur, and an experienced public and private company director. There is such keen interest in this topic. And I thought it would be also interesting to know how large is the global community of public and private company directors. So I looked it up. There are 6.5 million public company directors worldwide, and even more private. And there is such a deep interest to understand this shift to stakeholder capitalism and how we can measure it by operationalizing environmental social governance, ESG. But there's also confusion. There are many different frameworks. There are different rating agencies. Directors are confused. Should we start now? Should we wait? Should we do an incremental approach? And that's what we're going to be covering today. We're going to be talking a little bit about the history and the future and where we're going on ESG. And we're extremely fortunate in our panelists. We have with us today from the World Economic Forum, Professor Klaus Schwab, who is the pioneer and the thought leader who created this concept. We're also joined by Brian Moynihan, who is the chairman of the International Business Council and the CEO of Bank of America. Also with us is Carmine the Sibio from Ernst & Young. Carmine's the CEO at Ernst & Young and has been working with the other big four accounting firms to reach a common core set of metrics for measuring. Diligent Corporation's CEO, Brian Stafford, is with us. And Diligent is the leading corporate governance platform and our host today. With this as background, Professor Schwab, please may I ask, would you lead off and give us your thoughts and frame up the topic of shareholder and ESG and how you're thinking about stakeholder capitalism?
Thank you, Betsy. When I first documented the stakeholder concept in the early 70s, I described what to a certain extent was then already general practice, at least in a number of companies. The first Davos Manifesto, which was unanimously accepted by Davos participants in 1973, with only one abstention, stipulated that, and I quote, "The purpose of professional management is to serve clients, shareholders, and employees, and to harmonize the different interests of the stakeholders." And it says, in addition, that management has to serve society and must assume the role of a trustee of the material universe for future generations. So why hasn't stakeholder capitalism become even more widespread in the last 50 years? I think it's because something else happened in 1970. Nobel Prize winner Milton Friedman also published his doctrine at the time. It said the business of business is business. It held that a firm's main responsibility is to its shareholders, and that it has no greater responsibility to the public or society. In the following decades, Friedman's concept won out. It became the mantra for many boardroom decisions for corporate behavior. Many forgot that a corporation is not only an economic production unit, but also a social organism, having in many ways a determining impact on the life of its employees, its customers, and ultimately society at large. Today, a narrow shareholder perspective is not sustainable anymore. In a society with increased social awareness and social activism, we need again to turn to stakeholder responsibility. It doesn't mean we should seek conflict between shareholders and stakeholders, because short term, there might be frictions, particularly if shareholders expect short-term profits at all costs. But long-term, shareholders and other stakeholders should have one common objective: to strengthen the vitality and prosperity of the corporation. Corporate decision-making should not only safeguard the goodwill and support of shareholders, but of all those other parties who are essential for the company and society at large. What does a modern stakeholder company look like? Allow me just to highlight three considerations which have become crucial, particularly in today's context. First, the COVID-19 crisis has brought to the fore the crucial importance of corporate resilience. You have to manage for the long term and take into account today increased turbulence and unexpected events. Second, in a society which becomes more and more empowered and passionate, as we have seen lately, gaining and keeping public trust will be the most important long-term driver for corporate success. And finally, a company has additional responsibilities in the age of the fourth industrial revolution, which has emerged in this millennium. Just think of big data and data responsibility. All these concepts were woven into the 2020 Davos Manifesto, which we released in January of this year to critical acclaim. But even with all these additions, there's still one thing missing to make the stakeholder concept tangible. That is metrics. Indeed, nothing is credible if it's not measurable. And comparison is essential, particularly on an international basis. Today, we are here to find out how to walk the talk. My friends have been working on a roadmap to make ESG reporting really happen. I want to thank particularly you, Brian Moynihan, who is chairing the International Business Council, comprising of 120 global top CEOs. You are working together with the 4 audit companies represented here by Carmine the Sibio of EY to develop this roadmap. Thank you both. And a big thank to you, finally, to Diligent for hosting us here and having this important discussion.
Thank you very much, Professor. Really helpful, and it frames up the history and where we've come from and where we're going forward. Please may I ask, as the chairman of the International Business Council and the CEO of a leading public bank that is actually implementing ESG, Brian Moynihan, you have a couple of perspectives. Would you share your thoughts?
Sure. Thank you, Betsy. Thank you for hosting us. Thanks, Brian, for hosting us, and thank you for doing the work today. I come to this as in 2 roles, as the chair of the IBC and as the chair of Bank of America. And Klaus gave you the background of how we got here, but let me just flesh that out a little bit more. So we charge ourselves with the IBC, the 120 senior leaders of major corporations, really came about for a number of reasons. One is there's a proliferation of metrics and measurement systems, and we're all addressing those as boards of directors and CEOs of companies about how we get measured, even by people we don't participate with. The second is there's an emerging trend among investors to dedicate funds to ESG. And while it's still a small portion, it is growing and becoming more important. It's the way the general investing population is expressing, the asset owners are expressing their view that companies have to move. The third is there's been research that basically sets out that companies who do not fare well on ESG, you may not be able to predict outperformance. What you can predict is if you'd avoided the companies that fared poorly on ESG, you would have avoided 90% of bankruptcies in the last decade. That holds true around the world. That research by our team is actually fundamental. So if you're an investor, you're saying, if I can avoid the ones that are going to fail, I'll have a better track record. So there's an intellectual basis for that. There is data that goes the other way. It says outperformance, but you can get more arguments. So we wanted to focus in on the data that was harder to refute. And then you came down to, we all believe in, basically the stakeholder manifesto, the Davos Manifesto 2020. And in 2017, we all signed a document that said we would implement the SDGs. Society spoke what they want companies to do who are going to be stakeholder companies. That means make progress, meaningful progress in the SDGs. So if you take all that, we basically try to come up with a way to measure that is not controversial. It's a lot of measurement systems are in place. It brings them into one format. And Carmine and his colleagues were instrumental in helping us figure through things which really could be done by companies, not things that are theoretical. And the idea is if we get companies to consistently disclose on that, what happens? Number one, you align all capitalism to making progress on SDGs, not just charity, not governments, not what we do in our smaller programs, but what we do with our entire company. Two is you give investors a way that they can look across a group of companies and say who is good enough so I can stay invested with them, as opposed to being faced with a decision to divest or invest. And that's an important decision for the boards of directors, because they could end up on the divest side of these equations, and the capital will have to leave their company. The third thing it does, it gives the owners a way to measure the same success when they give the money to an asset manager, saying, okay, if you put your money against these metrics, the people who are above the bar on these metrics are doing well. What will happen? I, as an investor, will know that my money is going to help make stakeholder capitalism real. I know my money is measurable, and I know that you're going to pick the companies that are above the standard. And by having that objective standard, which Carmine and his team have done an excellent job of helping us figure out, you can now make that measurement. Therein lies what happens in the end. The capitalism gets fully aligned against the SDGs, and we are able to produce profits for our shareholders and produce movement for society. And then you go back to Klaus's 50-year history of trying to educate the world about stakeholder capitalism. So it goes full circle and across all those constituencies. And I think it's critical that we all keep that in mind. It is doable. We have tested it, and now we're busily trying to put it in place across these 130 companies, and then hopefully by that fact, even into more broader constituencies.
Thank you so much, Brian. Carmine, as the CEO of Ernst & Young, you've really taken the rubber hits the road operationalization part of the phase of taking the ESG core metrics and going through a process, collaborating closely with your four fellow big four companies. Can you talk a little bit about how this builds on what's already been out there that directors may be familiar with, and what your process is, and share some thoughts to frame this up for us?
Sure, Betsy, and thanks for having me, and thank you to Professor Schwab and to both Brians as well, Brian Moynihan and Brian Stafford. And thank you, Betsy, for having me. So a couple things. We did get a call about a year ago from both Professor Schwab and Brian Moynihan about participating on this project with the other big four and a team from Bank of America as well. And so we all put together teams. We have 5 teams working on this, the 4 from the big four and Brian's team from Bank of America, to make sure that we were all aligned. And that started happening about a year ago. Then what we did is we made sure that we took all the metrics and all the information that was out there from a lot of different organizations, whether that's SASB or TCFD or GRI, because there's been a lot of work done on this already. We, in fact, at EY, were involved in a project called EPIC, which developed some metrics and so forth. So we distilled all this as a group, the overall team, the big four and Bank of America team, distilled all this at the very beginning. And really, the concept was, some people talk about the alphabet soup here in terms of different organizations and so forth. We wanted to bring it all together so actually companies can sign up to something, and we wanted all the big four to be involved. So today, I'm not just representing EY, but I'm representing, all the rest of the big four as well. As we gathered that together, the teams came up with 22 core metrics and 33 expanded metrics. Now, the 22 core metrics are really broken down into 4 general areas. And that's, the first one is around people, and KPMG was the lead on people. So we had leads from the big four on each one, but we also all interdispersed our teams so that there'd be cross-pollination. So we also then had principles of governance of the organizations. That was led by Deloitte. we led prosperity, and PwC led the planet. So these metrics, we took a look at these metrics and really started socializing the metrics a couple months ago with the different 120, 130 companies, and that's just coming to an end now. And to give the group a little bit of a sense of the metrics themselves, so under the people metrics, for example, one of the things that we think companies should measure is diversity. And in the environment today, we think that's incredibly important. Gender pay gap would be another metric that's part of the people metric. The planet metric around greenhouse emissions and carbon footprint. Governance around board composition, around setting an overall purpose for the organization, which we think is incredibly important. And then prosperity, things like what kind of economic value are you bringing to the community, and so forth. So that's just a little bit of a flavor of what these metrics are like. We're going through the socialization phase right now that's just coming to an end. And, we've had different responses from different companies. Some think that we maybe have too many metrics and we have to start with a fewer amount of metrics, which we're going to work through. We want to make sure that we get as many companies to sign up on this as possible, because that'll give us momentum to move forward. So we're all going to be talking about this at the August IBC meeting. And then hopefully by January, by the World Economic Forum, we'll have all the companies really ready to sign up. And so to me, as board members, as directors, it's important that you all have conversations with your management, with CEOs. We at EY have been having a lot of conversations with our clients and our client CEOs to take them through these metrics, make sure they understand them and so forth, and make sure they give us good feedback during the socialization phase. I think it's important that you all as directors get involved in that. I know many of the CEOs have been presenting these to you as time has gone along. And then also, this really dovetails nicely with what's been going on at the BRT in terms of really stakeholder capitalism. And so we really want to try to figure out a way to measure that and to compare, as Professor Schwab has said. So we're all working on this together. It's the only initiative with all the big four working on it together. And I ask all of you as directors to get involved, read the metrics, and make sure that your companies are talking about it.
Thank you, Carmine. I really appreciate that. And I think that the whole director community is going to be vitally interested and eager to share comment and feedback during this phase. If I may now, Brian Stafford, as the CEO of Diligent, the global corporate governance company, you deal with, I think it's about 657,000 directors on your platform. I'm sure you've got a perspective that we'd all really appreciate and welcome hearing. Can you share your thoughts?
Yeah, thank you, Betsy, and thank you, of course, Carmine, Brian, and Professor Schwab for gathering for this important topic. At Diligent, as you mentioned, Betsy, we serve a community of more than 700,000 users, primarily directors on this webcast today, and as well as other C-suite. ESG is actually the topic I hear about most frequently from our users. And it's questions about or confusions around the many standards and frameworks that exist, a lot of curiosity around what others are doing and what they believe that their company should be doing. And there's an appetite for and a real need for global leadership and direction on ESG. And I'm thrilled about the work of the IBC, the World Economic Forum, and the Big Four about being able to bring this to the director community. Thank you so much for being here. Betsy, what are you hearing on your boards?
Well, it's interesting. The public boards that I serve on are starting to adopt or have already adopted. How about yourself? What are you doing at Diligent? Have you actually implemented ESG?
So it's interesting within the private company space, which we've been speaking a little bit more about the public company side, but the hundreds of thousands of private equity, in particular the ones that are owned by of the thousands or so private companies, particularly the ones that are owned by private equity, there's actually quite a bit of push and standards from LPs around ESG and ESG reporting. And so we do report and share ESG data with our private equity owners that goes to their LPs on an annual basis.
Interesting. Professor Schwab, What do you think would speed adoption? Do you have any thoughts about what external influences will speed the adoption of ESG?
If I talk, the World Economic Forum has also a youth organization. And if I talk to those people, particularly during the last months, there's enormous pressure from those young generation people to move forward. They are expecting with great interest what is coming out. They will keep us accountable for the progress and to make really progress. And I think what will be key for companies in the future is the trust factor. And trust will mainly come from proven ESG performance, if I may say so.
Yes, I think you're right. Brian Moynihan, all of us directors in the audience would love to hear what you're doing as a public company at B of A. How are you operationalizing and implementing ESG now?
Well, we have a strong set of programs that we have that are substantive programs of what we do. But importantly, it's aligning our entire company. So we publish our human capital report, which in it has a lot of the people metrics that Carmine talked about earlier. And we'll reconcile that's probably has more, frankly. And that talks about our diversity and our inclusion, our equal pay for equal job, and those types of measurements, our diversity of our board. So we publish that. Then we publish an ESG report today, which talks about all the work we do, whether it's the $400 billion environmental program we have or other aspects. But the point we're making here is really the complete alignment of the entire company. So what we call the genius of the and. So, as we set up the way we think about it, that we say we have to produce for the traditional stakeholders in our companies, our employees, our customers, and our shareholders, and we have to produce for society. And so that's how we kind of have our company thinking about it. So we operationalize through the company, which is we have a term called responsible growth, but one of the attributes of that is sharing our success with our communities. That's ESG, but also having a company that's financially successful so that it can perpetuate that in the future. And so whether it's our human capital practices, whether it's our environmental practices, whether it's our philanthropic and giving, and most recently due to the issues going on in America and the need to address opportunity, we put extra $1 billion, which basically doubles or triples our efforts over the next 4 years against opportunity. Everybody should have equal access to opportunity. That's a fundamental principle of capitalism. It is the access to the opportunity should be there. There have been studies in the United States that show economic mobility and opportunity may not be fair for everyone. You take the COVID crisis and put on top of it. So we said we had to put an extra $1 billion of work against that. And so we announced that over the next 4 years. So we have specific programs, we have general programs, but at the end of the day, what Carmine and his colleagues in the Big Four are doing is enable us to align the entire company. And a way to think about that for all these companies is I would encourage every director here that's going to hear this, does the company you sit on the board of have a carbon neutral commitment or not? If they don't, they should. We're not saying which year, just disclose a path. And the reason why is that sets in place a course of activities, which requires the company to rethink how it's going to operate and get its environmental footprint down over the next X years. And so you've seen the major oil companies announce this. You've seen companies like ours, we're carbon neutral today. And now do you use offsets? There's a way to score the offsets. So board of directors members can take very tangible actions like we have at Bank of America to say, where's our carbon neutral commitment? Where our human capital report? Where's a few other things that then frankly will feed the metrics we're talking about. But the reality are things people are doing, but the outward commitment of them will help get that trust back that Klaus talked about.
It's incredible the leadership that you've shown and the $1 billion pledge, and it is inspirational, and it's great to have that out there as sort of a bright light for other companies. Carmine, what do you tell your clients? I'm sure they're asking you questions. They're a little confused. How do they assess? Where do they start? Do you give advice to your clients at EY? Can you share a little bit about that?
Thanks, Betsy. Yes, we do give advice, in particular on this topic, and a lot of it. And I will tell you, there are a lot of questions in terms of this, the crisis situation we've been in terms of COVID, and is that going to help this or hurt this. And there is no doubt in all my conversations with our clients that it's actually going to help this initiative. When you really think about it, two main themes that are going to come out of this COVID period. One is around, if we want to use the word, the planet or sustainability, where more and more people are talking about this. And it's something that companies are realizing, that they can do things more efficiently. They can do things with reducing their carbon footprint and so forth. So Betsy, on that, when I speak about EY, we committed to being carbon neutral in 2020, which we will get to, and we were going to get to that by buying some offsets, which was the only way to easily get to that. We spend over $1 billion in air travel, and that's 85% of our carbon footprint. And now that's gone pretty much almost to zero, not quite, but almost to zero. To use Professor Schwab's words, it's a great reset for us. We don't think we need to be back to spending $1 billion and creating the carbon footprint that we had. We think we can do our jobs with less of that. Obviously not zero, we'll always be visiting clients, but with less of that. And it'll be easier for us to be carbon neutral. But I hope all companies are taking this time to really think about what they can do, in particular on sustainability and planet, that they've been using during this crisis that they can take on further. The other theme besides sustainability is around income inequality. And even before all the racial matters that have happened in the US and globally, this was a conversation that was going on because during the COVID period, it was really people who were not, as fortunate from an economic standpoint. They were the ones really getting COVID and dying of COVID more around the world, not just in the US or Europe, but around the world. So that is another conversation here where this is going to be very important going forward. So when you look at some of the metrics around people, diversity is a big metric that I think we should all be focused on. But also wages and so forth is something that all companies have to look at, and the metrics around that. So it's a great opportunity to actually, speed this up in terms of disclosing metrics, in terms of really coming together on which metrics as we come out of this crisis.
Thank you. And I think a lot of companies are feeling that. It's incredible the amount of conversations going on in boardrooms, private and public, on these same themes. Brian Stafford, you're the CEO of a private company, and all of your clients are private and public companies using the Diligent platform. Can you talk a little bit about how you think about and what advice you might have in perspective on should only large cap public multinationals like the IBC be going forward with ESG? What do you think about small caps and mid caps, mutual funds? Will you share your thoughts there?
Well, I think the leadership coming from the IBC and the Big Four is really, really helpful to help to catalyze and provide kind of the simple playbook for how you can actually disclose how you're performing around ESG. I think when you look for the most part across all of our clients, or candidly all across all of our teams, whether you're a company that's 1,200 employees like the size of Diligent or any other company out there, I think being an authentic organization and actually standing up and putting your values on paper and putting action behind them, I think matters everywhere to your employees and to your clients. So I think the leadership will come from the World Economic Forum, the IBC, and the Big Four, but I think that has the potential to really cascade down to so many other parts of the organization, and actually has at the core of it the potential to make us better. Thank you so much.
Professor Schwab, earlier in your comments when you were sharing the framework and the history of how you created the World Economic Forum and your first manifesto in 1971, you talked about the opposing argument or theory that Milton Friedman put forward. It makes me think, and I'm sure our audience is curious, how do you think about the various stakeholders? Is the shareholder have primacy over the employees or the community? Can you talk about the relative importance in how we ought to think about who makes up the stakeholder group and has which amount of influence in your mind?
I think the key will be to create always the right balance in terms of changing external conditions. And I would like to come back rapidly to what Carmine said related to COVID. I don't see COVID necessarily as a game changer, but as an accelerator. It's certainly an accelerator. And I think there are two very important, let's say, considerations. The first one is, I think COVID has shown us that material success, profits, or whatever we want, however we want to measure, let's say, material success, are not as important as well-being. I think the world will switch from a world where material success is the priority, much more to a world which is thinking in terms of well-being, because we have seen now with the health concerns, that there are fundamental factors which determine our happiness in life. The second element which I see now related to COVID is that at least even in Switzerland, many companies can only survive because the government helps. And so people will ask afterwards, what are those companies which society rescued, we, the taxpayer, what are they doing for us? So there are two elements which certainly will put much more pressure to go into the direction of stakeholder responsibility. But I would like to come back to what I said in my initial words also. The young generation will play a much more determining factor. And when we talk about stakeholders, of course, we talk about clients and all the rest and so on. But I would make a plea that we, when we look at the overall concept, that we give a particular importance to the young generation, because ultimately the success of companies will very much depend on the goodwill those the young generations will show towards corporations.
You know, I think you're making such an important point. And today, the millennials are 37% of the workforce, and the Gen Zero is over 21. So when you look at that, and you look at the multi-stakeholder environment, the pull of your employees and your customers and your investors, because these two groups are your employees, your customers, and your investors. They care passionately about this. And I think it's a really good point for companies, particularly legacy companies that may be a little bit reticent and slow to embrace stakeholder capitalism, ESG. Those constituencies are key. Brian Moynihan, may I ask you, just as a mini tutorial for our audience, you know, not everybody is, I think, 100% clear on the International Business Council and the Business Roundtable and who the organizations are, how they collaborate. Could you just talk a little bit about that to inform us and how they've been thought leaders?
Well, the International Business Council is under the World Economic Forum, which Klaus started many years ago, which has hundreds of strategic partners, but it is a group of, there are various communities within the World Economic Forum, the International Business Council being the largest 120 companies, as Klaus said, and the CEOs from those companies. We also work closely as the IBC with industry verticals, the oil and gas industry, financial services industry, which are also part of the membership. And we also work closely with the investment management industry vertical, which owns our stock. And then also the family office, which gets in the private company discussion. So that's what the IBC is, top 130 companies, the CEOs, and trying to figure out where we take various initiatives. And the initiative of the moment is, let's agree that we've got to implement the SDGs in large companies and make sure we make progress on those. And the metrics work and the ESG measurement work as a way to show the world that we can make progress, and we do make progress, and we hold ourselves accountable to make progress. The BRT is an American-based set of institutions, generally larger companies, about the same number of members, a little bit more, but it is a group of CEOs. And what the major change that Carmine referred to earlier was the BRT last extant statement on record before this new one was really stakeholder primacy. And whenever we as large companies talked about we're going to make progress on this broader constituency, the BRT statement would be held up as saying, wait, your trade group, for lack of a better term, your policy making group in the United States says shareholder primacy. So the BRT adopted a set of principles under leadership of the governance group and Alex Gorski over the last year that basically broadened out and made it clear that stakeholder capitalism, what they have. So that was a good backdrop for us at the IBC, which was already down this road, to bring those two efforts together. So the BRT is American companies and some multinational, but generally American companies. The IBC is a global set of companies, large companies, but also by their very definition and signing on to it have shown that they care to implement the SDGs, they care about implementing stakeholder capitalism. And they also represent, in both cases, many of the largest investors in the world who also are the people who are judging companies like ours of whether we're making a progress. Therein lies the metrics work.
Thanks.
Betsy,
please.
If I just may add, I think we need a global mobilization process, and the IBC and so forth companies are doing the basic work. But at the end, we need the buy-in of everybody. I mean, of the members here, of all the board members who are listening to us. We are also in contact with some business organizations like Kaidanren, the Japanese business organization. And I think it becomes a worldwide movement. It's not just anymore, let's say, the idea or the concept of people who feel socially more enlightened. No, it becomes a global necessity, and it will have global dimensions.
And Betsy, I'd add that Klaus is exactly right. So if you think about groups Klaus and I are even involved with, you have the Sustainable Markets Initiative by Prince Charles is leading, and he's helping drive that, which we've embedded the same principles. You have Mark Carney and the work he's doing for the COP26 and some of the principles there, and the work as UN envoy and as British envoy. You have the Council for Inclusive Capitalism from the Pope and the Vatican, and that has the principles. So one of the jobs that Carmine and others and Klaus are trying to do is as these worldwide groups, which many of your constituents are listening today would have some connectivity to on a global basis or even in countries basis, we're trying to make sure that the metrics thought process maintains relative consistency through them, because it incorporates the TCFD, it incorporates sustainalytics and things like that. So it gets you a way that you can go across all these bodies who start to struggle with metrics building to say, wait, there is a set of metrics. Let's not have all our time on the metrics. Let's think about how we get this group of constituencies to take action. And that's what we have to move this to, is taking action to move the metrics and arguing about the metrics and the calculation. And I'd ask your directors, and I'd actually tell them it's going to come at them one way or the other way, is to help their companies learn about that. Because if you don't get there, what will happen is the capital that's in your companies will start to channel away from you. And so that isn't a threat. It's just what's going to happen as more and more people, as Klaus said, sign up to the principles, drive it across all these different business organizations, all these investor organizations. Capital is moving to the companies. They're doing what Klaus said, driving the good for society and driving good business performance, good customer performance, great teammate engagement, et cetera. And so if you don't think that's true, just think about how many times you've seen this come up over the last 3 months in all these various groups. It's coming at you. And so the idea is join the fight and help us push this through so we get to a common set of metrics, but in the end of the day, to help achieve the great good, which is actually increase the ability of people to get opportunity on a fair basis across the world.
If I could add to this, one of the questions we get is, where are the regulators, where are the standard setters and so forth, including on the metrics? And so we've been having conversations with the EU, who has an initiative around this. We've been having conversations with the SEC. So I'm hopeful that as we move this project along and as we get companies from the IBC to sign up to these metrics, that the regulators will also jump on board, because once they do, and it becomes more norm in terms of these metrics and disclosure and so forth, that will help the whole process. And so that's, for people who are asking out there, well, where are the regulators and so forth? They're very interested. We've had a lot of conversations with them. I think we need to get through this project and get through consolidating these metrics so they could act as well.
And it's voluntary. And I think that's very interesting that the work that you're doing at EY is, first of all, based on a lot of the different frameworks that are out there. Whether it's SASB, GRI, CDP, you're not inventing new metrics. You're taking the most important metrics that track to the 4 big principles of the SDGs and the Sustainable Development Goals of the SDGs, and you've broken this out and creating a voluntary movement globally to embrace these. I wonder, do you believe that we'll have clarity by the end of the year that we can all look forward to? Can you tell us the time frame and process a little bit that you're working on, Carmine?
Well, we are hopeful that by the summer meeting of the IBC under Brian's leadership, that we'll have a good discussion around this and we'll have a good basis to move forward, in particular with the core metrics, because we have to get to a point where we settle on core metrics so we can move forward. And then, as I said before, the plan would be that at the World Economic Forum in January, that we're able to really sign the companies up to this and to the commitment in terms of disclosure for that upcoming year. So that's kind of the plan right now. We've been going through the socialization phase. And you could imagine there's 120 or more companies. And so some want to disclose more, some want to disclose less. There's certain industry sectors where they have concerns, but we have to get to a point where we can, settle on some core metrics, and then we could phase in some of the other ones. And certainly companies can disclose more than the core metrics as we go forward.
Brian Stafford, you're dealing with 700,000 directors. Tell us a little bit about the interest in the director community and intensity, because, as both Brian Moynihan and Professor Schwab have identified this global initiative. Are directors ready? Are they leaning in? Are they curious? Are they confused? Give us the snapshot that you deal with and see.
Yeah, I think the answer to your question, Betsy, is a little bit all of the above. They are leaning in, they're curious, they're confused. And I think Brian Moynihan, one of the points that you highlighted, I think is spot on. Right now, most of the questions that we get asked are around what data should we be tracking? What are the right standards? And less actually around, let's identify them and then focus on how to move the needle on those. And I think through the leadership of everyone who's on this call, of actually helping to define, getting the alignment around it, which is no small feat, can actually have us get to a core set of metrics that then we can actually be focused more on the right thing, which is how do we actually move the needle on those metrics and show progress and help to improve things. And I think that leadership coming from the 120 largest companies, going down to a broader set of company through the big four, I think will then cascade into other parts of the economy, whether it's the large set of private companies that actually do rely on funding, to Brian Moynihan's part, as well from different sources. And so I think this really does have the potential to waterfall and have a cascading effect. And I hope for all the directors who are on and joining, hopefully these standards can help to mobilize some of the conversations in the boardroom and help to move towards moving the needle on after arriving at a common set of standards.
Brian Moynihan, as the CEO of a public, famous global bank, directors are curious. Are you just doing one set of, did you pick only one framework? Are you implementing and responding to multiple frameworks? multiple rating agencies? Because that's kind of some of the confusion we hear as companies get ready to implement. Can you talk a little bit about that?
Well, in fact, we, by definition, have to respond to multiple frameworks and then sub-frameworks within a topic. So you might have on the environmental measures, multiple people's viewpoints, and then increasingly, even within specific investors, their own proprietary viewpoint. And so, we're a company that is carbon neutral already, that has a $400 billion environmental commitment. We funded through $150 billion. And still, we can rate low on somebody's and high on somebody's, different measure, and there's sort of no logic to it, for lack of a better term. So that's why we're trying to get these metrics coalesced, as Carmine said. So we basically have to report into all the different groups that everybody is familiar with, whether it's MSCI or Sustainalytics or TCFD or the SASB disclosure, and all those reports are going out. Yet the problem is that each group can come up with another report, and then from a director's and efficiency standpoint, from the CEO and the CFO and those, you just have to supply, because if you don't, you could be put at the bottom of the list, even if you're better than everybody on the list. And so that's kind of, if you say what's in it for, what's in it for anybody, what's in it for the company? The company is, if I can get people to agree these are metrics, then I can actually build a reporting system into those metrics, and that's enough. I don't have to go off and chase everybody's newest idea about something. And that I think is part of the criticality of what we're trying to get done, is to agree these metrics are good enough, but also to simplify for companies the number of different places of reporting. And that's to Carmen's point, why with some of the regulators, the EU, with some of the other major initiatives going on, you're trying to get them in a room and push the things, think of them as a bunch of circles which partly overlap. How can you push all the circles on top of it? And then, by the way, behind that, companies can decide what to do, but if they do this, it's good enough. And the investors can say, if they do that and they're above the bar, that's good enough for us to stay invested or stay lending to them. In the case of the bank, think of us now as a lender. And owners can say, if they do that and they're above the bar, I will either invest directly with them, or I'll tell my asset manager that manages the money for me that they can invest. And that symmetry is what we're after. So we report to everybody. It's a constant effort to add more. That perfect metric, I can get 5 people in a room and say, if I just had this one metric, to Brian's point, it would make us do all this stuff. And you're saying that's not realistic at this point. Let's just get a group of metrics that we can all understand and then measure the progress. And that's the key, is to have the same metric year after year to show you've made incremental progress on your 2 admissions or your 3 emissions, or whatever the measure is, or your gender pay equity, or your representation, or you pick it. But it's clear progress that then go back to the last point, which is Carmine and his team can actually, they build a plan to audit to them. And so that they have the standardization of the methodology of counting, which is also important.
Sometimes when we have these conversations, in particular with CFOs, that one of the things that will come back is, well, we're disclosing so many things, and all our documents are this thick, and this would be something else to disclose, and we need the data and so forth. So just so all the directors know, the technology companies out there, we're working with them, our counterparts are working with them to make sure that they're focused on this as well, and that they're able to, obtain the data for each company, that they have modules around these metrics, and there's processes around these metrics. Because as Brian said, eventually the metrics would be audited to give assurances to investors. And so there are a lot of initiatives out there with technology companies, in terms of the actual process on gaining the data for the metrics. So, the excuse of, it's another thing and so forth. I think there's a lot going on that really goes against that, in terms of, processes in place, data in place, using whatever ERP system you're on and so forth. All the ERP companies are really focused on this. We're working with them on it as well. And so there's modules set around this.
Can I add one thing, Betsy? It really goes to Brian's point on private companies. One of the fears as we have looked at these standards is if all the big companies adopt them and private equity doesn't, what you'd have is business activities migrate away from public companies into private companies in an effort to, have a regulatory arbitrage, or in this case, a metrics arbitrage or disclosure arbitrage. So I think that may be a risk in the near term, but this already goes all the way back to Klaus's point about the new generations and your point also. If the private equity firms who get their money from, investment funds, universities, state pension funds, all these people, they're not going to be able to, invest in a private equity firm that does X and invest in public companies under different standards. That their owners are not going to allow them to do that. So I think if I'm a private equity firm, I could say, well, I could just arbitrage this for a while and hide, think about oil company generation or something. If I took the company private, I could get it out of this debate. I don't think that lasts long, because I think your underlying investors in those firms, unless it's all your own money and you don't have to answer to anybody, are going to are having the same standards applied to it. How do we know that? Because remember, we are an investor for $3 trillion of assets through Merrill and our private bank. And those clients who invest in all the private equity firms, et cetera, are saying, you can't put my money with a company. It's not going to live up to the certain standards. So that alignment is helpful. But I think the private companies have to think hard about this. We keep talking about public, but it's more important to them, than they know at this point.
Yeah, one point to build on Brian Moynihan's point. I think we are seeing a lot of the LPs push even harder on private equity firms than you actually see in some cases than public equity investors can. And so the requirements before a company makes a new investment typically comes with, on behalf of LPs, a long set of disclosures that need to be made. So I think my commentary for private company directors as well is this is coming across both fronts.
If I may just add one point, when I talk to companies, I see sometimes a psychological barrier because people feel it's a beauty contest and you have to be the best from the beginning on. I just want to underline what Brian said. I think what is important is to be capable to measure progress. I'm sure not every company will, if it's above the bar, it's good, but not every company will immediately win a gold medal. But every company should try to win a gold medal over time. And those, let's say, standard help to see what is actually the progress.
Actually, it's amazing. We're pretty much at the end of our hour, but the comments that you make about the journey of ESG is really what we all need to start. So let me at least first thank our 5,000 plus audience out there. And we thank you for the questions that you sent in that we've covered some of, and your engagement and your curiosity and your commitment. And particularly, I want to thank our panel. We couldn't have better thought leaders who are really walking the walk and leading us forward. Also, I think we come away with a much deeper understanding of stakeholder capitalism now and how it's being actually operationalized through these new ESG standards that are being developed that will be embraced in a voluntary market-led way at the end of the year. We also learned quite a bit about the IBC and the 120 leading global companies that are going to hopefully sign this and just like the Business Roundtable and implement in the beginning of January next year, these new core metrics. We do want to keep the dialogue going with you. We want your comment, as you heard from everybody on the panel, your feedback, your interest, your energy around what we're doing. And we're also going to create a thought piece from all of us here on the panel, which we'll put up on Diligent and be able to be downloaded and shared with you. But most important, I want to leave with a call to action. As you heard, absolutely now is the time to start. I would really recommend at your next board meeting, you ask management, how can we start to measure ESG? All of our companies have great human resources policies. We all have diversity, inclusion, equal pay, wellness, OSHA, data privacy, good environmental policies. We're doing so many good things as companies. We just need to start. Capture the information, communicate it, start measuring it, pick a framework, pick a rating agency, and begin. I think that all of our various stakeholders, our employees, customers, our community, and our investor shareholders, they care about what we're doing. And we will be well served as directors if we start now. So don't wait. Please do bring this up at your next board meeting. I think you'll find it a very rewarding and robust conversation. Thank you again for all of your time today. I wish you a great day. Bye-bye now.